first current market condition. Spiders, this is a 10-day stock forecast toolbox. This is our flagship product. This is optimized for short-term predictions. I'm looking at the 10-day predictions for spiders, and right now, basically, model saying that there's not a lot of momentum to the downside. We did not make new lows this week, so this is a win for the bulls. We retested the previous week lows. And the model basically says the range for the next 10 days is neutral. So based on the data and based on the news, market can go as low as maybe retest the 281.73. That's this week and last week low, or potentially 280. This is a close to 200-day moving average, or rebound back to the close to the 50-day moving average, which is around 289 to 90. And that's probably a good assessment from the technical perspective where the stock market can be in the next 10 days. From the longer term perspective, I'm looking now at the seasonal chart. This is part of the tools. This model is optimized to make longer term prediction. I'm looking into the next 50 days and I'm analyzing 25 years worth of data, right? So in terms of how much data we're analyzing, stock forecast toolbox might analyze only past few months and give more weight to the most recent data. Seasonal chart takes different perspective. It takes longer term perspective and says, in the scope of the last 25, 30 years, what do we think based on all of this data? Where is the momentum for going now into end of October? And the model actually had a strong signal for higher, basically saying that as we're going into October, we're probably approaching the bottoming process. We might have 5–10% correction currently, but the model sees potentially reaching 273 in the next 10 days. This is a 10-day signal, or retracing back to the all-time high 304. But in terms of October now, a 50-day horizon model basically says we are approaching probably bottoming process, and going into October, the stock market should recover. So how do you trade based on that information? I'm looking at the bar chart, spiders. I like to look at it for futures data and the equity data. So again, we're trading right between the Bollinger Band, lower band, Bollinger Band. 200-day moving average is around 200 days, 280. We tested last week lows. We are probably 50% retracement at the 287, 288 level. This is, if you take 50% retracement from 282 to 294, right? 282 to 294, that's 12. 12 divided by 2 is 6. So 282. So we're right at 50% retracement. So flip of a coin, the stock market can go to the 50-day moving average, or it can go to 200-day moving average, and this all depends on the news. So how do you trade in that? I think at 288, it's a flip of a coin. You can go long, you can go short. I think it's just going to depend on the news. When the market approaches 50-day moving average, personally, I'm going short, and you can see it in the market commentary. I encourage you to read, if you want a kind of daily update of where I think the market, where the key support and resistance levels, you can read these market commentaries. They're all pretty much, in terms of support and resistance level, identify the same. Potentially overshooting to 277, 280 is considered buying. 293, 50-day moving average is the overhead resistance, potentially overshooting to 293, 294, and that's kind of the price action that we have seen. So I think you will see a lot of sellers coming in at 294, and you will see buyers at 280, and that's what we have seen. 282 we've touched already 3 times. 294 we've touched probably 3 or 4 times. So that's the range. And in terms of where you can put trades that have high risk, limited risk and high reward, right? You want to structure your trade ahead of time to make sure that the risk versus reward makes sense. So that's those are the trading zones, right? Right now, it's a flip of a coin. At 294, I think you have higher chance, right? You can look at the implied volatility. You can look at our tools that can tell you what the odds are, but 60–70% chance that the stock market will revert back. At 280, 60–70% chance that the stock will revert back. And you put a tight stop orders, 1%, 1.5%, to make sure that if we do break to the upside, or if we do break to the downside, then you can alter your opinion about market trading in the sideways range and either become bearish or bullish. But right now, probably market neutral. What else is interesting to see? Treasury prices. I would keep an eye on bonds and treasury. I think consensus is that we make this unprecedented move in treasury prices. There's a lot of competition for all-time low interest rates, negative interest rate in Germany, negative interest rate Italy, France. China is devaluing its currency, so it's a race to the zero, and a lot of foreign countries are basically buying treasuries and moving money to United States where you get a higher interest yield. So for the market to continue rally, I think the treasury prices have to go down. Sometimes treasury, bond market and stock market moves in the same correlation. Historically, that is not the correlation you want to look for. So for the market to rally, treasury prices have to sell off. I don't think it's possible for treasury bond market to go higher in terms of prices and the stock market to go higher. So something has to give. Right now, we have a short-term correction, not very meaningful one. So I would keep an eye on the bond prices. This is a 20-year bonds TLT that is highly covered, and bond prices and yield move in inverse correlation. Everybody talks about inverted yield between 2-year yield, 10-year yield, and 30-year yield. So I would keep an eye on that. Gold, just as important. This is a safety, right? People are concerned about the current state of the economy. There's a lot of uncertainty in Britain in terms of Brexit. There's a lot of uncertainty in terms of Italy, uncertainty in China, Hong Kong, Iran with oil inverted yield. So market doesn't like uncertainty. We're supposed to impose 10% tariffs on $150 billion. So that has been reduced from $300 billion to $100 billion. So a lot of uncertainty on May 1st, a lot of uncertainty on, July 1st, and then July 15th in the next FOMC meeting. So as long as the uncertainty is in the market, VIX will stay elevated, right? Let's go to VIX. Probably VIX is better, the index itself. Let's do VIX futures. So we've been trading between, before the FOMC meeting, we were at 14. We we retested twice the 23, 24 level. Now VIX down as the market goes up, but VIX is still elevated. 20 is the historical average. There's no sign of panic, but you still have a lot of uncertainty in the market. TJ, thank you for the kind words. Yeah, I would encourage to look at the market commentary. It just kind of gives you perception. Here's the support resistance level. I mean, if you follow the news and you're trying to, predict the news, I think you will run behind the train, right? And you will always do a catch up. If you want to be in front of the train, kind of not in front of the train where it tries to hit you, but in the same direction. Instead of following the market, if you want to try to predict the market, then you have much better chance not pay attention too much to the news, but looking at the key support resistance levels. And if you break support and resistance level, then you look at the news, right? If the news are significant enough and support is broken or resistance is broken, then you have to be flexible, right? And change your mind in terms of where the market is heading. But as long as the market is trading between 200-day and 50-day moving average, all the news is basically, it's a noise, right? It's a noise, and you look at the news and you have hindsight bias, right? You watch the news, they are trying to explain, do a post-mortem analysis of what happened in the past and do kind of a confirmation bias and try to explain why things are the way they are. So I personally try to, news are very important, but they're important in terms to answer one and only one key question. Will the support be broken, or will the resistance be broken? Will we go below 200-day moving average, or will we go above 50-day moving average? That you need to know. Everything in between is just going to be a lot of noise that does not impact overall market trend. So VIX is important. We talked about VIX, still elevated. And again, VIX, I would also keep an eye on VIX. In my experience, in order for correction, right? I don't think we're in recession or we're in a bear market. I think this is a short-term correction, right? At least for now. So I would keep an eye on how all of these correction ended, right? October correction, May correction. Usually you have some kind of spike in volatility and you break key support level for a couple of days and then you rebound. So this capitulation where VIX suddenly spikes and you have a panic in the market and everybody's closing their long position, that is usually the sign of capitulation. Right now, I'm not sure we had that sign, right? It's kind of a steady market sell-off, reaching key support level, market bounce, nice and steady. Usually capitulation is done by big spike in volatility and some key support level being violated, kind of a false breakout for a day or two, like we had in May, like we had in December, and then quick recovery. So I think right now that's the only sign, even though we did not breach the previous week low, which is good. I think this is something that market is waiting. Right now it's kind of a very regular, orderly correction, orderly moves in the market. Even though obviously 800 move on Dow Jones is not very orderly, but it stopped right on the right on the 282 level, which is close to this May 13 low. We haven't had another move to the downside. So that's kind of one thing what I would exercise a caution and not chase the market when it's at 290, 293 level and wait for that panic in the market before you become a bull. And for now, just assume it's going to trade in the range. DYX, I would keep an eye on the US dollar. Right, this is strong gold, strong treasuries, strong dollar approaching again 52-week high, all-time high. This is not a good sign for the bull market, right? If everybody's devaluing their currency and it's still a strong US dollar, that will in fact Dow Jones index. It will affect companies that bring a lot of revenue from outside of the United States with a strong dollar. And that's also probably negative news for the bulls. Another sign of capitulation, I think XLU has to sell off, the utility sector. Where do people hide their money? They move into gold, they move into safety asset classes, treasuries, gold, US dollar, utilities at all-time high. Consumer staples holding on, outperforming the market. So typical signs of the late stage bull market in terms of consumer staples, utilities, REIT, everything that pays you dividend. That's where people are hiding money right now. I think for the capitulation to occur, these sector classes have to sell off, right? I think the only reason market is still holding on 200-day moving average is because utilities are at all-time high, financial REITs are all-time high, and consumer staples. For the market to capitulate, they need to drop to probably the lower Bollinger Band. That would be a better sign that the market has capitulated. Piero, the question was on stock forecast toolbox. There's also a futures forecast toolbox, and often there'll be different numbers and different trends. Why is that? The main reason is that stocks is based on the U.S. market session that's open from 8:30 Central to 3 p.m. Central, and we're only looking at this data. Futures, especially now, can actually show you completely different data. Futures is almost 24/7, so we're looking at all of the data, and this is a very good question. So now we just looked at spiders, right? And if you look at the spiders, you might say, well, 50% retracement is at 282, and overhead resistance is 294. But if you look at the futures, which should be highly correlated, it reflects European session, it reflects Asian sessions, right? It reflects Australian market. So all of a sudden here, how do I delete this thing? So all of a sudden here you see a print of 27.78. What happened? Well, that was when China, well, either devalued its currency or the Chinese currency dropped significantly, right? It happened very quickly. It happened in the Asian session, and market dropped to 27.78. So if you look at the spiders, you don't see this print, but if you see it European and Asian session, which you should, because now Chinese economy is the second largest economy, and the news from Europe and China can affect the market. Elections in Italy, Brexit, and so on and so forth. All of a sudden, you see almost retracement, close to the May low, where you don't see it in the regular spider section. But the model, just like the model, looks at all the data. So that's very important to keep in mind, that the futures are running 24/7 with few breaks, 15-minute breaks, but the ETFs are running only during US market hours. Thank you for that question. So we went over current market conditions, support and resistance. I would also look at Russell 2000, small cap US stocks that are not affected by stronger US dollar or what happens in China. You see that they also broke lower Bollinger Band and sitting right at the key support of around 145, right? We're seeing the May low, this is March low, November low, October low, so the very key support level. It hasn't breached that level, but it's trading below lower Bollinger Band. Biotech sector, same price action, way oversold, below 50-day moving average, right at the lower Bollinger Bands, 2 standard deviation moves. So it's a market is oversold. These indexes are oversold because based on historical data, this is a 2 sigma move. 96% of the time, the market will revert, right? But in only 4% of the time, it will reach that level based on historical data and historical volatility. So we're sitting at the key support level. If you look at the China, it briefly, I believe, breached the July low, the December low. So it briefly breached December low. It rebounded now, but you want a confirmation, obviously. So this could be a false breakout, but nonetheless, it broke the December level, which is probably a leading indicator of where the market could be heading. And then emerging market. Right, so I would keep an eye on these levels, but you can see that a lot of indexes, emerging markets, similar picture, broke the May low, approaching the December low, and probably the weakest sector is energy, oil drilling companies, Schlumberger, Halliburton, broke the December low. So this is probably the weakest sector in the market is the oil drilling company, again, because of the demand from China. So a lot of indexes are sitting at the main support levels. The good news, for the past 2 weeks, we were able to hold on to these support levels. The bad news, the market is oversold and prone. If there's any negative news in the market, from technical perspective, it's sitting at the very key strong supports. But from the news perspective, if there's any negative news, and there could be, we have a lot of sources that can come from negative news, that can breach that support level and the market can sell off. So it's kind of a tug war between bulls and bears. How do you deal with that?